Good morning, ladies and gentlemen. Well, the risk dial is still in very positive territory. Anything about 30-40, above 30-40 is decent. I would like to see it come up in the 70s and 80s very soon. That would give me more confidence. We have daily risk on, we have monthly risk on, we'll have weekly risk on next week. So there is absolutely no reason to think that we are entering any kind of bad period. If we look at the deviations, which I would encourage you to look at daily, we can see that basically the market is crawling up the top towards the top red line, and that is where we have the resistance to the move. You will see how well that worked for the best part of last year, and I think we are in much the same kind of period now. I encourage you to look at all the various different sectors of the market, because those are the ones that will mean revert and then move further and further. The most interesting one that I see is actually XLK, which is this one, which has more room on the upside, but the steepness of the move is just unsustainable and will become clear at some point. This XLK, which equates to NQ, is entering a dangerous period, and at some stage that will actually come back quite hard. That's the only one that I have some reservations about. All the other ones are trading very nicely within their channels, and please look at it on a daily basis, and you will be able to pick out certainly tops with great conviction. The yield differential between bonds and 10-year notes still firmly stuck in the middle of the channel it's been in for a very long time. So the dollar just cannot break out while this kind of behavior is happening. There is pressure on the dollar to start going higher as overnight rates basically make holding any other currency difficult, but it has no impulsion while this channel holds. At some stage, I do expect this channel to start breaking out and this kind of behavior to reassert itself. Until that happens, all you can do is basically be long of calls in the dollar and then trade the market from extreme points, which is exactly what I have been doing, and I see no reason to change that pattern of behavior. I will go into the dollar and hedging levels for calls into much more detail later on. But just to say that I see no reason to change that kind of behavior, and I see no reason why the dollar should break down suddenly, simply because there is no fundamental reason for it to do so. If the previous chart holds and we are in a very tight range between bunds and 10-year notes, then by looking at the bunds, we must be arriving at decisions about what the 10-year notes are going to do. 8 basis points is absolutely your swing level. If the market now starts going through 8 basis points, you know that you have a move probably all the way up to 20 basis points, something like that. So you know you're going to have quite a sizable backup in yields. I see no reason why that should happen, and therefore 8 basis points is my absolute swing level. And I am looking at this 5 basis points level that the market backed up to as an indication that we are going to go and test at 8 basis point, and that we are no longer in a trend here in bunds as we have been for such a long time. I absolutely love that at 8 basis points level. It is so important. It is the one that will determine my actions in the credit markets for the foreseeable future. This is a chart of the yield of the 5-year note. I wrote last week, here it is, stuck between 225 and 240, and that's basically exactly what's happened. This is 240, this is 225. The market cannot get out of that range. The Fed came and basically put the kibosh on any silly talk about easing immediately, or any idea that the Fed wants higher rates for some reason. The Fed wants neither higher nor lower rates, and this kind of behavior within these Bollinger Bands, I think, will continue for quite some time. Absolutely no reason to think that we're going to go outside of those ranges unless the Bund starts breaking that 8 basis points level that I think is so important. No reason to expect it, no fundamental reason. You can easily fight both the 225 level down here and the 240 level up here. Not much more to be said about the 10-year note either. The 260 level is going to be very tough to break, and I don't expect it unless the Bund does so, breaks that 8 basis points. The impulsion to the downside, I think, is going to be minimal. So I think yields are now stuck in a 20 basis point trading range for quite some weeks. And I do mean weeks. And that will actually put the kibosh on volatility in equities as well. The dollar is basically just going back to sleep. I thought that there might be impulsion to break higher, but I think the Fed actions have put this market to sleep as well. I am going to remain long of calls simply because I think that that is the danger, but I have been hedging above 97.87 and buying back at 97.52. And now I think I will probably hedge again for a move back up, back down to 96.47. I think it's very unlikely that we break this 96.47 level that has been such an important swing level for such a long time. I still think the danger is to the upside, simply because I don't think that there is a cleaner shirt in the laundry basket than the US dollar. So all the danger is on the upside. The hedging trades that I do towards the 96.47 level are basically just that. They're hedging trades that I want to take off. I'm trying to pay for these calls and make them free if possible. If we look at things from a fundamental point of view, you will see that we are now hard against the time 17 Blue Angel, which is slowly going to crawl up towards the 3000 level, but it's going to take, a few weeks for it to do so. So what does a market do once it's hard up against some kind of a Blue Angel? Well, it takes a rest. It does what it did here. It backs off and comes back. It backs off and comes back, probably making a kind of wedge like it did here in early 2015, or it collapses to the times 16, or it melts up to the times 18. I mean, I'm not telling you anything very original here, but what I'm trying to say is that we are playing a game of odds. Why should the market melt up to a times 18? Very few reasons. And why should the market collapse to a times 16? Again, very few reasons. If we think about it logically, what the Fed has told us is that rates are on hold. Rates determine the value of all other assets by which they are discounted, and therefore the highest probability that we have at the moment is that we stay tight against that times 17 Blue Angel and trade around it. The melt-up theory might be predicated only on the weight of money, i.e. people are very underweight equities, and at some stage they're going to have to reach. There is a decent possibility of that. I mean, it's not a huge probability, but there is a probability of that happening. That is why I keep on saying own calls. But don't own outrights, simply because if we do collapse down to the times 16, again, there is not much reason why we should, But there again, why hold outrights when volatility is so low and is giving you the possibility to hold calls for something which doesn't cost you very much? If all you're giving up is 1.25% over a 3-month period, not holding calls and holding outrights is almost criminally stupid. So that is why I'm saying hold the calls, and we are probably going to do what we did in 2015 and just crawl around the time 17 Blue Angel. That is the smart play. That is the one that the odds are the highest for. In equity, the picture has just not changed. On a daily basis, you can see how close the Bollinger Bands are to the market. We tried to do a quick down move. We failed badly to break this very important moving average, which has held the market for such a long time. Whenever we get that and a quick push up, we will trap some longs up here and come back down. That to me is very consistent with the behavior of deviations. We push to new highs, the market fails, comes back, stops people out, goes back again. Basically a whole series of cup and handles. Eventually we will crawl up towards that 3000 level, but it's going to be very slow. I think the market over the course of last week went up a total of 5 ticks. That's what, less than 0.25%. I think that behavior continues. And it's not surprising that it continues, because it fits in with what I've just been telling you about yields and the US dollar. In which case the volatility on the upside is going to be muted. Eventually what we will have is a consistent wedge up into the 3000 area, and at some point we come straight back down towards the 2900 area. It's a trading range. Do not chase this market. This is not a market to chase. This is a market to trade. 5-10 points is all you can expect from a market which has such low volatility. The one market that I told you last week might see a rotation into it is the Russell. And if you think about it, why should people rotate into Russell? Well, people rotate into things that have a higher potential of profit, and basically they move up the risk scale when they feel comfortable that volatility is low and going to remain low. So when things aren't going to change, they chase things which could have a decent amount of upside and catch up with the market. The Russell is the one that it's still a good 10% lower than the previous peaks, and therefore people could now start chasing that and rotating out of S&Ps into Russell, which is what is happening. This market over the course of the next 2 or 3 weeks has the potential to go up to this kind of level. We're talking about 1660, 1670, while the S&P does very little really. Would not surprise me in the slightest, but I don't think it's going to be a massive thing. We're talking about a 3% catch up, that kind of thing. I certainly am long of calls in the Russell. I have been for quite some time, and I will keep on rolling them simply because I think that we eventually hit the 1700 plus level, this kind of 1701 to 1710. But that is just a trade. It's not something that I have huge conviction on. Otherwise, I would have outrights as opposed to calls. Please always bear in mind the monthly level of the Bollinger Bands in the SPX. Nothing good happens when we break higher than the monthly level. We always retrace at least to the breakout level on the monthly. And that is at the moment around the 2985, 2990 level, because the Bollinger Band will go up with the market. but it won't go up very much. So 29.90 is the last level that you can have any kind of comfort in trading. Anything above 3,000, you know that the market is going to come back down and retest it at some stage. So, you have another 1% on the upside. And that is why I've been saying for a long time that it is just silly to hold outrights here as opposed to calls, because the risk is nowhere near as weighted towards as the downside. There is a real danger always of coming back down to these levels, the 28, 25. I mean, I don't think the market comes any lower than 28.64 for a long time, but there is a danger that that happens. So the danger is much higher on the downside than it is on the upside. To me, holding calls is the right course of action, and not holding outrights. Having shown you the Russell area earlier and saying that people are reaching, well, they're also likely to reach in a period of dollar stability, excuse me, for EEM, simply because they're reaching for yield. So it would not surprise to see EEM test the 45.10 area, which is so important. You can see that the market has held the 50% retracements at 44.83 very well, just ticked it, came right back down, and now probably going to go up and test the 45.10 area. If we break the 45.10 area with any conviction, I would have thought the 61.8 retracement at 46.54 is almost guaranteed. So you have a decent trade here. This could be easily a cup and handle, and we trade above 45.10 all the way up to 46.54. But I think this 45.10 area will definitely trade again. So this is actually consistent with a period of time in which the Fed has put the kibosh on volatility. People are reaching, and therefore they're rotating out of S&Ps. They're buying Russell, they're buying EEM, they're going for the more risky stuff simply because they are reaching. And this is precisely what volatility is saying. I have my levels above which volatility must not go. If we are in an orderly market, which is just slow, tightly trading towards the upside, to me 1150 is a very important level. I don't think that we trade below it for quite some time. This is where the Bollinger Bands are, and I will now enlarge this to show you anything really around 1150 and volatility has done all it's going to do on the downside, and that is your sign that the market is unlikely to go any higher in S&Ps, and that you can go in and do some bearish trades for just a quick retracement. The market is unlikely really to stay even in the 15s. So to me, any kind of move up in VXX is a sell, looking for new lows, and I'll show you that chart now. VXX, which used to be VXXB until last week when they changed the ticker, I missed selling it by 5 ticks. It's a shame, but I think that basically now it goes and tests the 24 area. The absolute maximum that it can go up to is here, 28.10, 28.20, 28.30. The yield curve in the volatility is so steep that the chances of this having a sustained move higher are very low unless something fundamental is changing in the market. So you can be short of VXX almost unpunished for moves down to 23.95 and eventually quite a little bit lower, simply because the VXX has such a steep yield curve on its holdings that the decay is so enormous. While the yield curve is this steep in volatility, and I'll show you the futures now, it is unlikely to be able to sustain any rally. This is a 300-minute chart of volatility, and I'm showing you all this because I want you to be aware of how volatility impacts the trading in futures. I mean, what happened last week? We got to the 200 period downward sloping moving average, and we just collapsed from it. We are unlikely to trade above this level of 1550 with any kind of conviction, or remain above it. You can see how, we did a quick ABC and then just collapsed lower. Over the course of the next couple of weeks, I expect this to continue down towards the 12s, at which point it will no longer have it won't be decaying anymore, and anything with a 12 big figure is a buyback in this May volatility, simply because it's just not worth the risk anymore. But at 14.25, it's definitely going to go and trade into the 13s, which tells you almost with certainty that the S&Ps are going to make a new high at some stage next week. So what are our biases for next week? This is what I said last week, and in 5s and 10s I see absolutely no reason to change anything. The market is trapped between these levels. Absolutely nothing to add to it. Here I've told you the 8 basis points to me is the absolute swing level, the absolutely important level in bonds, and if that relationship between 10-year notes and bonds holds, and I see no reason why it shouldn't, that will tell you all you need to know about the direction of the US credit market. Anything really below 164.80 in bond futures, and I'm no longer bullish of bonds. I think at best we're in a sideways market with danger that we break this 8 basis points level to the upside. SPX, well, I said, what does the market do? It does a lot of work, and at the end of the day, at the end of the week, it's made like 5 ticks, and that's precisely what happens. Why change what works? I'm saying it's gonna continue to do absolutely the same thing. These are your very important support levels. Not until the market breaks 28.64 will I be concerned. So that's all there is to it. NQ, it is going up faster simply because people are reaching, but to me at some stage that becomes completely unsustainable. It's wedging, it will continue to wedge. You can see what deviations is telling you, that the market will continue higher. I am absolutely sure that next week it'll make higher highs, i.e. over 7,900. It could even get to 8,000. But that is still a trading market. Do not get married to long NQ positions. Buy the dip, sell the rip. IUT is the one that could now get going. Above 1602, 1603, it is bullish. You should really transfer calls from S&Ps into RUT. It has a better odds of performing. Volatility 1150 to me is the absolute bottom. 1425 is the top unless something big is changing. Closes above 1425 and I start getting worried. But that is all there is to be said. To me, volatility is a sell on rips. European equities, the DAX is breaking higher. To me, 12,650 is almost a given in DAX over the course of the next week. And that is where I will take profits. DXY, I have told you what I think. The market could come back to 96.50 quickly. To me, 96.50 is the absolute level where you no longer want to be short of any dollars and you want to start building again sizable long dollar positions. But even 97.54, it's not going to be so easy to break on a sustainable basis. There is no reason to suspect that the dollar is going to do anything worse than trade down to 96.50 and then retry the upside of 97.54 and 97.87. The odds longer term are still that we see these levels 99.79 and 101.92. Thank you very much indeed, and tweet you on Monday.